How's it going, guys? My name is Met Eish and welcome back to Met Eish. In last week's episode, we had a look at the beginning stages of investing in the stock market. And that was to ask yourself the question, should I invest in the stock market? Since we went over a few other avenues, a few other things you could do with your money before looking at the stock market. So if you haven't seen episode 1, please click the link on screen or in the description below and go and watch episode 1. There are a bunch of questions there that you can look at to see if investing in the stock market is the right option for you right now. Today we're going to take it one step further and we're going to assume that all of the questions in episode 1 are answered and you are ready to invest in the stock market. We're going to go over what we look for when we buy individual stocks or ETFs. We're going to have a look at what exactly to look for. So, before we get started, please remember that this is not financial advice. I am not a financial advisor. This is a blank cup. Blank cups. Put your logo on my cup. If you know anyone who could benefit from this information, please share it far and wide and hit that like button, subscribe down below and ring the bell to be notified every time we upload new videos. So, let's get into it. What should I look for when I am starting to invest in ETFs or in single stocks? These two questions we've already answered. So, to find out more about our ETF series, click over here. Description is also down below. And to find out more about our dividend investing, which covers a broad view of what to look for when you are investing in individual companies, you can go over here. And the link will also be in the description down below. So since we have already covered these two topics, we're not going to go that in depth. We made mini-series out of them on purpose so that we could cram as much information into those videos as possible. And I highly, not just because I want you to watch as many Met Eish videos as possible, I mean I do, but I also think that you will get a lot of benefit out of watching both these series. So please go ahead and check them both out. When we look to buy an ETF, we look at three things. We look at what index or market that ETF tracks. We look at how accurately it tracks that benchmark. And the most important thing to look at is the total expense ratio. How much you are paying for that ETF. That is the biggest deciding factor that we look at, especially if we have multiple companies offering the same thing. So for ETFs, it is very simple. If you want to invest in the top 500 companies in the USA, you go for the S&P 500. Signia is the cheapest. If you want to invest in the top 40 companies in South Africa, you go for the JSE Top 40. Satrix is the cheapest. If you want to invest in rhodium, there's an ETF for that. If you want to invest in property, there are multiple property funds as well. So, for an ETF, you look at what it tracks, how closely it tracks that benchmark, and you look at the total expense ratio. For single stocks, however, when you're beginning and you're starting out, there is so much information that you need to take in that you really just need to read. Google. Google is your best friend. Google everything. If you don't understand a term, Google it. I often don't understand why people turn to Facebook and ask questions on Facebook when they would be far better served asking those questions of Google. Facebook is full of people who want to take your money. Google just gives you, here's the answer, there we go, done. What we look for when we look to invest in an individual company is, we've said it before on the channel, we look for 5 key indicators. And those are top line revenue growth, earnings growth, strong free cash flow, low debt, and a reasonably priced or a well-priced stock. The first item, number one, top line revenue growth, is literally all the money that a company takes in. And you find it on the very top line of the income statement. Hence the name. Top line revenue growth, all of the money that a company gets in. That is what that is. We want companies to be growing their top line revenue year over year, and especially for multiple years. We want companies to be getting stronger and making more money over time. Number two, earnings growth. That is how much money the company is actually keeping after it pays for its capital expenditure, or its operating expenses, or any sort of money that the company needs to pay out. This is how much profit the company is making, and we again want it to be growing every year. You want your top line revenue growth, you want your earnings growth, and you want your cash flow to be bigger numbers every year. You want the company to be growing and expanding and making more money. So if you've got strong earnings, strong revenue, you are very likely to have strong free cash flow. Now, free cash flow to equity is how much money you as the investor would be entitled to if you pulled a Warren Buffett and bought the entire company outright. If you bought this company and you took it private, how much money could you draw out of that company? Once again, bigger number is better. So the first three, the bigger the better. Brings us to debt. Debt is used by companies to fund expansions, whether that is into different markets, into different product ranges. Companies use debt all the time. You want as little debt as possible. Debt kills companies. So you want as little debt as possible, or at least the company must be able to fund its debt. If it needed to be liquidated, the company could cover all of that debt quite easily. And the last one is a well-priced stock. This has nothing or very, very little to do with what some chart says. Has very little to do with the actual price of a share. There are two ways that I like to gauge whether a share is well priced or not. The first is the PE ratio. And you can go to our Instagram. We have a very nice story where we break down what the PE ratio is and how you can use it to determine whether a share is well priced or not. You can take your PE ratio and compare it to competitors in the same industry. You can compare it to the market in general, and you can compare it to that company's own historical PE to determine whether this current price is a good point to buy the stock at. You can also use an enterprise value to EBITDA model. And that means that you take all of the assets that the company owns and work out the value of that enterprise. You then divide it by the EBITDA, which is the earnings before interest, taxation, depreciation, and amortization. And I encourage you, please go to Investopedia and look up all those terms. If you don't understand anything, Investopedia and Google, best friends, your best friends. Just keep reading. So those are two ways that you can look to see if this company is well priced compared to itself. Not just because the share is 5 cents. 5 cents could be really expensive for a terrible company. So that's the criteria we look for when we look at ETFs or when we're buying individual stocks. And there are far more things to look for. There are other metrics. Different people use different things. Like I've said before, there are 1,000 ways to skin a cat. We don't condone cat skinning. Please don't skin any cats. We have never skinned a cat. We don't have a plan to. Don't go ahead and skin cats. Please, I beg you, save the cats. But there are multiple ways to get a job done. These are just the ones that we prefer to use. Once again, not financial advice. blank cup, not a financial advisor. If you know that you are not going to put the effort in to do the research, then it is far better for you to invest in an ETF. And there is nothing wrong with ETFs. ETFs are great. Most people don't beat the market average that an ETF gives you anyway. So investing in ETFs is a great way for you to not have to worry about reading through pages and pages of financial statements, because let's be real, most people don't enjoy that, and if you're not having fun, you're not gonna keep doing it. So don't force yourself to be a single stock investor if you know that you're not enjoying yourself. Investing is supposed to be fun. Once again, if you want to find out more information about how to pick ETFs and how to use EasyEquities, the website, hit the link down below and check out the video. Thanks for watching, guys. If you found this video helpful, or if you know someone who is going to benefit from watching this video, please share it far and wide. Share it with everybody. Send it to your ex-girlfriend, send it to your ex-boyfriend, send it to everybody. And say, hey, watch this Met Eish video. I will greatly appreciate that. You can also follow Met Eish on Instagram and Facebook and everywhere where Met Eishes are. We'll be doing a live Q&A this Saturday, the 21st of August, from 6 to 7 Central African time. So if you have any questions that you would like to have answered by us at Met Eish, you can comment them down below. And while you're down there commenting your questions, hit the like button, subscribe to the channel, and ring the bell to be notified every time we upload new videos. We do it every week, roughly 6 o'clock on a Sunday, so just when carte blanche is going to make you really sad, come and get your money sorted out on Met Eish. So please, I look forward to seeing you on the live. And if you have any questions that you want to ask us live, you can hop on and we'll chat face to face. Why not? So I'll see you next week on that live. And before we go, remember, blank cups. Put your logo on my cup. Thanks again. Good night.